This is a podcast produced for EIS Platforms Limited, trading as growthInvest. It is not intended to be a financial promotion of any sort and is intended for financial professionals only. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high-risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you're prepared to lose all your money.
Hello and welcome to Alternative Thinking, the podcast with me, Melissa Griffiths.
And me, Steve Dobson.
This is the podcast that takes a deeper dive into the alternative marketplace and explores topical issues. Today, we're delighted to be joined by Marcus Stuttard, Head of AIM and UK Primary Markets at the London Stock Exchange. Welcome, Marcus.
It's great to be here.
We're going to look at AIM, the Pisces framework, which has just come out. We always like to start with a bit of a background on yourself, your role at the London Stock Exchange.
Well, it's great to be here. So, as you said with my title, I am Head of UK Primary Markets. So I have a regional team who spread all across the UK and who spend their time doing two core things, really. The first is talking to our existing AIM and main market listed businesses to make sure that we understand how they're feeling and they're getting the most out of being public. But also the rest of the time is spent talking to private companies about their future funding journey, their plans. Historically, that's been about when those companies, if or when they might come on to do an IPO. Increasingly, and as we're going to talk about today, it's about how the capital markets can support them from an earlier stage. And really what we're trying to do at the London Stock Exchange is create a seamless funding continuum from startup right the way through to FTSE 100, so that UK companies can start, scale, grow and stay in the UK, whether that's privately or on the public markets.
And there's no gaps in that kind of funding throughout their journey.
That's what we're trying.
That's the dream.
That's the dream.
Yeah.
Perfect. And obviously we've got Pisces, which is the new framework that has been put together, backed as well by the Labour government, pro-growth. So what is Pisces and what's the sort of main goals then for this framework?
So the first thing is that Pisces is the name of a brand new regulatory framework, the private intermittent securities and capital exchange regulation. Yeah. The previous government really started the process, and so we've been working with the government, with the Treasury, with the FCA, with other regulators for the last 2.5 years, probably 3 years, to really look at the whole regulatory framework in the UK and recognise that this actually is a world first. It's a framework that will allow companies to stay private but have that periodic access to liquidity. Yep. And so it's the framework. It will enable a number of operators to launch Pisces venues. Ours will be called the private securities market. Yep. And we're really just trying to make sure that private companies have access to liquidity for their founders, for their employees, for their early stage shareholders. Yeah. So, one of the things that my team regularly find is we can establish really long-term relationships with companies, sometimes 5, if not 10 years ahead of a potential IPO. And one of the most frustrating things is when you identify a company and a management team that ultimately want to go public, and you think, actually, this will be a great public company one day. And in the intervening period, the business gets sold. And quite often, the reason for that early sale is because the founders, the management team, come under pressure or want to provide liquidity, whether that's for employees, whether it's for angels, early stage shareholders, whether it's for VCs. And so we want to take that pressure away. Now, I think what's really important to say, though, is this is not just a venue to enable companies ultimately to do an IPO. Right. A lot of companies will stay private, and we know that is a growing theme, something we might come on to talk about.
And I read that the period that companies are staying often private has grown, hasn't it, over the last 10 years,
I
from
think the
7
median,
to 10?
yeah, like I said, the median's gone from 7 to 10 years over 10 years, isn't it?
That's right.
Yeah.
And one of the positives, actually, I mean, particularly in the UK, is that we've got a much more thriving sort of private market. We've got the biggest VC community in Europe.
Yep.
And so companies have got access to that early stage finance quite often. It could be improved. We'd like to see our own domestic investors investing more. But we want to encourage those companies to continue to scale and grow and to take that liquidity sort of pressure off them. I think the other thing is that if you think about the broader reform agenda in the UK and all of the focus on encouraging our pension funds to invest more into equities and not just into listed equities, but also into private companies.
Yes.
And you combine the Pisces framework with that pension fund reform and the fact that, the Mansion House Accord signatories, the 17 of them, are wanting to access the private company asset class to a greater extent. You combine those two things. Pisces venues should enable companies to not be under the same pressure to provide liquidity for shareholders, but also to slightly more seamlessly rotate their shareholder register.
Okay.
And to get some of those later stage and those pension funds onto the shareholder register. And hopefully some of those bigger institutions will then end up being cornerstone investors for those companies that do want to go onto IPO. So this is all about making that sort of later stage in the funding continuum for private companies just a bit easier and a bit more seamless.
Well, it's very much been called the stepping stone, hasn't it?
Yeah.
In the
and for some it will be a stepping stone.
Yeah.
For others it will enable them to continue to stay private and continue to go private.
But with some liquidity.
With some liquidity.
Will that fragmentation cause problems? 'Cause obviously when we think about AIM or LSE, it's one exchange. Here there's going to be multiple venues and a company could choose any one of those. Is that going to cause problems, do you think, or is that good for competition?
Well, the short answer is I don't think it will create fragmentation, and I think the competition will be really healthy.
Yep.
If we bear in mind that just in the UK alone we've got over 5 million SMEs, and of those there are probably 30 to 40,000 what we would call visible scale-up, so companies of some real scale. There are plenty of companies. We've got great levels of innovation. Actually, despite sometimes the narrative about the UK, we've got some of the top universities. We've got some of the, we've got the highest level of unicorns in Europe. What we need to be doing is making sure that those companies can continue to scale in the UK. I think, who knows which venues might apply to become Pisces operators.
Well, that's what I was interested in, because we had JP Jenkins and AssetMatch on a podcast recently, and I just wondered, are more coming in? There's obviously yourself, so that's 3 players.
So what we potentially envisage is different players operating at sort of different stages of that funding continuum, or at different sizes.
Right.
So we had an event at the London Stock Exchange a couple of weeks ago, where we had a group of companies and institutional investors together to sort of walk them through where we've got to, what our venue will look like, and most of those companies were £1 billion plus.
Okay. Oh, interesting. So the first movers could be quite large.
So there could be some large first movers, but it might be that some of the other venues are also talking to companies that might be at an earlier stage, or might have angels rather than VCs or private equity investors that want some liquidity. So I think what the framework does is it provides much more kind of regulatory certainty for these types of venues, so that venues aren't having to sort of operate on workarounds, the previous legislation, the Companies Act, etc. It just provides a much more solid framework.
And I just wanted to ask them, with those sort of larger potential companies that might come in, who are the buyers for?
So I think it's really varied, actually.
Okay.
So not only are we expecting some of the larger pension funds and the large institutional investors to be buyers, but also, we're expecting family offices, we're expecting high net worth investors.
Yep.
So I think there's a really broad range of people who want access to this asset class, where they want to be able to invest directly rather than necessarily through fund structures.
Right.
And that, by having not a guarantee of liquidity, but more certainty that these companies will be trading on a periodic basis. And the disclosures are now, the core disclosures are now set out by the FCA. It will just provide those potential investors and those buyers with a lot more certainty about the disclosure framework and the frequency of trading. And the fact that, the valuation is being set using kind of market dynamics but with the company very much in control.
Yes. Yeah.
So there are other platforms globally that allow investors to bilaterally trade between themselves. The challenge with that is that quite often the company is not involved in that process. And so if they haven't got any sort of control over sort of information flow or where that trade takes place, what valuation it takes place, it can leave the company, if you've got an investor that just needs to sell and they're willing to do so at a significant discount to the company and other shareholders' prevailing view about valuation, it can cause all sorts of problems.
Yeah.
So having a venue where the company is at the centre, it's in control of pricing, of the timing of auctions, of the disclosure, and you've then got the extent of the connectivity that an exchange provides, and you've just got more certainty around valuation. It just makes the whole process a lot easier for both companies and investors.
Yep.
And how frequent would those auctions be then for a single company? Is it monthly? Is it quarterly? Or is it variable?
So that's one of the things that is within the company's control.
Okay, so
they can set out how frequently they want to be traded. And I think a lot of that will depend on the size of the company, the likely liquidity, and it might be that some companies start with less frequent auctions to test the water and then make it more frequent. Right. But I think from the feedback that we've received from a lot of companies, we expect a lot of companies to start with either every 6 months or maybe an annual auction.
Mm-hmm.
Oh, okay. Because with Asset Match and JP Jenkins, did we work out the timelines that they were normally? Was it?
No, I think it's exactly the same. It's going to be driven by the company. So
okay.
It's an interesting, as you say, it gives a lot more control to the company as opposed to the underlying purchases potentially of those shares.
And I think one of the really interesting things we've been developing the market is actually how many companies have come forward and said, we're already doing a lot of this. We're trying to provide our own sort of, in effect, match bargain facility. Yeah. But we're doing it as a board with a spreadsheet.
Yeah,
and then even when we've sort of agreed a price and who should participate, there's all of the friction around paying stamp duty and emails and share certificates, and so just the efficiency of using the sort of market infrastructure that we provide and stamp duty not being chargeable on these transactions, is a huge gain for a lot of companies.
Yeah.
Just going back onto, obviously, great for companies staying private. I think I questioned you at a conference, was it late last year or earlier this year, about what does this mean for AIM then? Because obviously AIM has been a tough period, I guess, for AIM with, delistings, the number of companies there is much, much lower than used to be. What do you think this means for AIM? Is it, because it could be deemed as positive and negative, because it could mean companies stay private for longer, but as we said earlier, it provides that stepping stone also to progress onto AIM. So how do you position this and see this going forwards?
So, I mean, you sort of hear me use this term quite a lot, but our objective is to create a seamless funding continuum, and we see AIM and the main market as core parts of that funding continuum. What AIM celebrated its 30th anniversary last month, and there are lots of features of AIM, and the fact that we operate AIM as a separate market to the main market that is really beneficial for companies. There are core components of AIM, whether it's some of the fiscal incentives, whether it's the role of nominated advisors, whether it's the whole community of lawyers, market makers, nomads, brokers that have built up around the market that remain a real sort of selling feature internationally and a real benefit. But you're right, we've had markets globally have had headwinds over the last sort of 3 years. That's affected private markets, it's affected public markets, it's affected growth markets. But let's not lose sight of the fact that this year and over the last 10 years, 53% of all of the capital that's been raised across Europe's growth markets in total has been raised on AIM. This year we've seen a number of IPOs, we've seen some really significant transactions. Rosebank, so the ex sort of Melrose management team that launched Rosebank, did the largest ever capital raising that we've seen in AIM's 30-year history. £1.1 billion raised on AIM. So
and that was, just go back to that stat. 53% was it over the last
over the last decade on all of Europe's growth markets combined.
Yeah.
So so we are seeing transactions. I mean, let's not forget that sometimes there's a bit of a narrative of UK companies looking at US capital markets.
Yeah.
We had 10 IPOs on AIM last year, which is a lower number than we would like. But still, of that 10, I think 5 of those were US companies doing their IPO in the UK on AIM.
Yeah.
We want to make sure that our UK capital markets are as deep and broad as possible, so that companies don't even have to think about going overseas to raise capital, and not just in the public market phase, but in the earlier stages at the B, the C, the D round. What we really want is to make sure that that very deep pool of capital in the UK is being deployed into our domestic economy and to our brilliant companies at an earlier stage, so that they can continue to grow and scale in the UK.
Yeah, it makes complete sense. And then yesterday it was interesting. Obviously, there's a lot of announcements from Rachel Reeves, and one of those is about the listing task force, which I guess cements exactly what we're saying here about making the UK markets more attractive. Are you able to elaborate on the task force?
Yeah, I mean, with this whole package of reforms that started in 2020 with the review of the primary market's effectiveness, which essentially was a review of the main market listing rules. There has been huge collaboration between all of the regulators, government and market operators, and all of the other capital market stakeholders. And so I think we've made huge progress. The listing rules were rewritten and launched last summer. We've seen huge strides on things like corporate governance, on the whole access to capital. We've talked about pension funds allocating more capital to the UK. The Mansion House Accord now signed by 17 signatories. So a lot of progress has already been made, and we would sort of we often talk about our capital markets sort of being match fit on a global basis now. So a lot of that work has already been in train. You will have seen lots of headlines about companies having conversations in number 10, in number 11 with the government to provide their feedback into that reform agenda. And so there's already been a very close dialogue, obviously, between us as the London Stock Exchange and the pipeline of companies, and of course our existing issuers. And there's also been that dialogue with the government. I think what Rachel Reeves' announcement does is it sort of makes that more sort of concrete and sort of formalised.
Yeah, makes sense. Yeah.
And sort of now moving a little bit more into our space and onto inheritance tax. Obviously, there's been a few new regulatory changes. And what's your sort of thoughts with AIM? What are you going to? Where is AIM going to be now in terms of this?
So, I mean, first of all, AIM isn't just a sort of tax-driven market.
No.
There's a whole range of things I can come on to sort of talk about. We launched a discussion paper about AIM and the framework and the market within it, which it operates back in April. And so there's a lot of work going on there. But specifically on the tax breaks, business relief or the inheritance tax relief has been and continues to be a really important incentive. And it does a number of things. First of all, for founder-led or family-led businesses that are thinking about tax planning in the future, it's a really valuable encouragement, not just to think about selling the business, but to think about how to continue to grow that business and think about succession planning and to make the growth markets a feature in that. And then there's the fact that the relief attracts capital into the market, whether that's individual investors directly making those investments or doing it via one of the inheritance tax funds. And the top inheritance tax funds between them probably run between £6.5 to £8 billion. So it's a significant pot of capital.
Yeah.
So it's first of all, it's really important. And then obviously in the previous budget, the Chancellor made a number of changes to inheritance tax. One of those was to make people's pensions a less attractive inheritance tax vehicle. The other was to reduce the rate of business relief and to halve it. And that was for growth market name quoted shares, but also for private companies. I think that the thing that has slightly unleveled the playing field, if that's a term, is that for private companies there is £1 million exemption, but we've still got that 50% exemption, which is really valuable, and it allows companies that want to shelter part of their portfolio, but also support great UK companies in a liquid market with good visibility and transparency and good disclosure to be able to do so. What we really need, though, is for the government to create future certainty, because one of the big benefits of business relief was that it was a tax break up until the budget that hadn't been changed at all.
No.
And so there was a lot of certainty. And clearly with an incentive that is aimed at people looking forward to the long term, hopefully, they want the certainty to be able to tax plan. So one of the things that we've been saying very clearly to government is, could you put business relief onto the same footing as EIS and VCTs, for example?
Like with the sunset clause, where it got extended for 10 years.
We're not intending to make any changes to 2035. And I think even at a lower rate, that would then provide the certainty and the clarity that people
and
need.
allow tax planning. I mean, it's something we see regularly. We're talking about IHT, but actually there's still quite a lot unknown for advisors and their clients, and nobody really knows quite where to go yet. So, I think that would make a big difference.
And so for me, I think that certainty is important. But I think also, encouraging people as part of their tax planning to be putting, a proportion of their portfolio into productive assets is really important. Because, we talked a little bit earlier about, there being great quality businesses, both privately and on the public markets, on AIM, the main market. And as an economy, we need to be backing those companies. And it's surely got to be much better for people to be putting a greater percentage of their wealth and their assets into equities and productive assets, rather than either it sat in cash or too much of it sort of sat in other less productive assets like property. And I think that the tax breaks are an important part of that sort of encouragement process, really.
It's a tricky one, because we're a risk-averse nation, really. I mean, I look at my wife and she'll hold cash regardless of what inflation rates are. It's just, how do we get people to be more pro risk-taking? And we know there's risk with any investment you make, but, as you say, there's some great companies out there, and start looking at the actual fundamental companies they're buying, as opposed to, well, it's a tax break first.
So I think that is going to be an interesting transition as markets move.
But I think also, to your point, recognising that nothing is risk-free. And the biggest risk with cash is inflation.
Exactly.
So there's a really important sort of education point here. And so, I think one of the other recent announcements was around a much broader industry-led education campaign, so that people are thinking about having well-diversified portfolios, and yes, of course, having some cash for rainy days, but not having too much cash that is being actually eroded by inflation, and increasing the exposure to equities and the long-term growth that they can provide. I think I think Schroders did a piece of research that said, actually, if UK investors had put more into equities and reduced their cash exposure over the last 10 years, they would have been £500 billion better off.
Yeah. It's definitely, we've brought it up before on the podcast. There's Australia and Sweden, isn't there?
Piece.
Yes, and
predominantly, it's key. I think we need to get it in schools much earlier, that people understand it. And, you know, I've got two teenage sons, and you mentioned exactly the same, and you've got similar age daughters. And how financial savvy are they? I don't know, you know.
Yeah.
But they need to be, because it's important.
Absolutely. Yeah. I mean, I think New Financial, the think tank, did a piece of research fairly recently that asked people where they thought their pension pots were invested. And I think people thought that over 40% of their pension pot was allocated to UK companies.
And it's something like 4%.
4%.
I know, and I think it's going down, but hopefully
so
going to change.
I think, you know, actually there just being better disclosure about where people's pension pots are invested, and people having more control over saying where they want it to be invested is all part of that education. And as a society, probably talking a little bit more about companies and business and growth. Global investors are recognising the opportunity that exists here
in the UK.
The UK, and in some of the key sectors that have been highlighted in the industrial strategy. And we just want to make sure that also, you know, our UK individual investors and pension funds are recognising the same opportunity.
Yeah. Well, it's been absolutely fascinating.
It's nice to end on a very positive
yes, well, that's
note
what I always
there.
like to finish on, a bit of a positive note. So it's been great having you, Marcus. And yes, we'll be watching with bated breath.
And it'd be great to get you back on again once Pisces, you know, we've had some auctions take place and how well
Actually, just one last question. Any idea of timescale when the first sort of live trade auction might go ahead?
Yeah, so we're at a really advanced stage in the whole sort of project. So obviously all the legislation is now laid, the FCA's rules are finalised. The bit of the jigsaw that we don't yet quite know is how long it will actually take companies to prepare, because companies will have to make some changes to articles and things.
All right, so watch this space. Okay, perfect. Well, thank you, Marcus.
Yes, thanks for coming on.
To hear more, tune in to either YouTube on video or all good podcast channels.